Hello and welcome. You're watching Closing Trades here on ET Now, and we're coming to you live from the Suzlon studio. Now, in terms of how markets are shaping up this afternoon, let's quickly take you through how the Nifty is shaping up. And what we're seeing is around a 70-odd point cut on the Nifty now. So a far more tempered kind of move versus what we saw at the start of the day. Even within that, the advanced decline looks increasingly positive. You're seeing 35 advances to just about 15 declines at this point of time. Trent, Cipla, JSW Steel, Power Grid, Bharti, just some of the big gainers in trade this afternoon now. Axis Bank still continues to languish at the bottom, 5.25% lower. HDFC Bank also down 5%. Maruti, a little bit of a recovery on Kotak Bank is visible. But ICICI essentially and Reliance is absolutely flat. Those were the ones which were in focus on the back of the earnings that have come about. And you can see ICICI is still sitting in the green. But outside of that, you're seeing a bit of a tempered move on all of the others. Also, IT seems to be the flavor of the day. We've seen some decent moves within the IT pack, but or rather seemed like the flavor of the day at the start of the day. We've seen a sharp cool off from that point. We're now around a 1/10% lower on the Nifty IT index. So banks not contributing, IT not contributing. Let's pull up the contributors on the Nifty, and that'll give us a sense. ICICI, Bharti, SBI, and it's the breadth essentially. HDFC Bank and Axis combined contributing 175 negative points on the index. Of course, we've recovered from the day's lows, but essentially that's where the pain point or the pain pocket is. It's the private sector banks. In terms of broader markets, we're seeing a much better move, and understandably so, because we saw that play out even on Friday when private sector banks were actually leading. Now it's the other way around, and small cap and mid cap, both the indices are doing fairly okay. There's some bit of resilience seen there. Mid caps obviously outperforming versus small caps, and there too the breadth is positive. 3:2 on the advanced decline on the Nifty 500 index. Some gainers, PNB is the top gainer there, and that's obviously because of numbers, very strong. Schneider 5% higher, Sham Metallics up 5, Gabriel India up 5. You had promoter buying happening there. Union Bank up 4.5 plus, JSW Energy, Torrent Pharma, Oil India. The list goes on. Some very, very strong gainers there on the Nifty 500 today. The top loser is Axis, but outside of that, Mapma India is down 5.25. Gallant Ispat and HDFC Bank. I mean, I really didn't expect Axis and HDFC Bank to be the top 5 losers on the Nifty 500, but that's exactly how it's turning out to be. AU Small is the other one. Some bit of softness, 3.5% lower on AU Small Finance Bank. ITC Hotels down another 3. So you're seeing pressure come on the stock. ITC Hotels prior to earnings was in around the 180 rupees a piece mark. You've seen quite a bit of cool off post the numbers. Broadly, that's how it's shaping up. But before I take you through some of the buzzers and why, let me go across to Mithali. The banking heavyweights all wrapped up in one, all the first quarter earnings done, and what are analysts making of the numbers? Mithali here to give us a breakdown.
Right, so the brokerages, they remain quite bullish on the Indian private sector banks after the quarter one earnings, viewing the margin pressure as more of a cyclical event, while the long-term growth story for these banks, that remain quite intact. ICICI Bank, it remains a street favorite, while having a 49 buy ratings and one brokerage calling hold for this stock, while HDFC Bank follows with 46 buy ratings. While Axis Bank has 45 calls, but a few neutral as well as sell ratings after a weaker quarter one set of results. Kotak Mahindra Bank is the least preferred among all of this, though most of these brokerages, they have still recommended a buy on the stock. On the upside, HDFC Bank leads the pack with a return potential of nearly 26% from current levels, while Axis, Kotak as well as ICICI, they have an expected potential return rate of nearly 19%. Brokerages, they remain constructive on HDFC Bank despite some target price cuts, expecting the earnings to improve ahead as the funding cost ease for the company. ICICI Bank, it continues to attract the strongest support backed by consistent execution as well as industry leading returns. Axis Bank is seen as a margin recovery story, while Kotak Mahindra Bank is favored for its asset quality as well as the stable earnings. Now, the street's pecking order, it remains unchanged. First is ICICI Bank, which remains the execution leader, followed by HDFC Bank, which offers a very strong re-rating potential potential from the current levels. Then Axis Bank, which is the recovery play, and followed by Kotak Mahindra Bank, which stands out for its balance sheet strength.
All right, so that's how it shapes up. Let me bring on board Kunal Bothra as well. Give us a sense on how things are shaping up with regard to the private sector banks. Kunal, some sharp moves seen today, especially in Axis and HDFC. Would you go out and buy?
Not exactly on those particular banking names, but I think on the overall market, it's been a phenomenal market, Harsh. So, you know, X of the large cap private sector banking names, you look at the contribution played from across the broader market as such, I think it's been phenomenal, nothing short of exceptional. For example, at the current context also, HDFC Bank, Axis Bank and Kotak Bank largely are contributing almost 170 points on the downside for the Nifty, and the Nifty is down only 70 points, which means that there are far better contributors which are contributing more than 100 plus points for the indices. You look at the market breadth also, it's been very, very strong. The Bank Nifty, which was down, I think, at 1.940, 950 points, the last I had seen has recovered towards just negative 500 points so far. So it's the move which is there across the markets, devoid of these larger cap private sector banking names. I think that's where one should concentrate on.
Okay, so that's the tilt. And with regard to the index itself, Kunal, you seem positive, constructive. You believe banks IT will showcase a bit of a rebound?
Yeah, you know, the beauty about this market is how it's balancing out. You know, see, we've seen so many phases and textures of markets in the last many weeks and many months. For example, today you have large cap private sector banking stocks which have taken a back seat, but then look at how the markets have balanced it out with the PSU banking names making a dramatic comeback. Look at all of those PSU banking names. So looking at the contribution played on the relative strength scale, Union Bank, Indian Bank, Bank of India, Baroda, etc., SPI, these stocks have started to show signs of robust price action. IT stocks which had fallen very aggressively, that has stopped falling. So that market has a very natural way of balancing it out, and that puts the the positivity back into the markets. And that's why I would believe that once this churn or the market expectations with results to news or results, once this settles up, I would sense that we should be in for a strong breakout. Just one more point which I wanted to add was the mid-cap 50 index. So I was looking at the mid-cap 50 index, mid-cap 100, etc. Most of the mid-cap indices are coming back to their multi-week breakout zones. That's going to be very positive for the overall market breadth as well.
Okay. And IT in specific, Kunal, what's the view there?
See, I think at current juncture, I would believe that it's a good zone to try and look at selective IT names. There are two changes which have happened for IT stocks. One is they've stopped falling viciously in the previous cycle, what we've seen for the last, I think, 3-6 months, particularly. I don't want to go too long, but I think in the last 3-6 months, the kind of selling which we've seen for these IT stocks, that now seems to be behind. The second is that many of these IT stocks, slowly and steadily, are trying to balance out and perform very well in times when the markets are a little bit volatile, jittery, or lacking triggers in terms of positivity. And the third, the more important factor is that many of these IT names, I was looking at the large cap contribution as well as the mid cap IT stocks, are coming back into swing breakout zones. And those breakouts, of course, are on short-term time frame charts because of the massive selling we've seen for these IT names. But the fact that these stocks are able to conquer above their previous immediate swing highs, that's a very strong positive. So net-net, I would be bullish on the Nifty IT space from the current levels, and something which I've been highlighting over the last 1 to 2 weeks.
Okay, noted. What are your picks for this afternoon there for Kunal? How should one play the market? I mean, we've spoken banks, IT. What else?
So I'll suggest 2 buy calls, differentiated names. The capital market space is starting to buzz, very attractive. So Edelweiss is something which looks attractive at the current juncture. The stock is bouncing off from its 50-day moving average. Strong risk reward at the current juncture. Would look at a target of 130, stop loss at 115. The second would be a bond, Max Healthcare. Even this stock has, yesterday I think had shown a bullish doji kind of a candlestick pattern, bounced off from its 200-day moving average, and now starting to show signs of a contra up move or a recovery of sorts. So expecting this recovery to last till 1140 at least for Max Healthcare. Would suggest a buy with a target of 1140, stop loss at 1086.
Okay. All right. Let's also listen in to what the management of some of these private sector banks had to say on their con call earnings. Listen in.
Number one is, I think not just, you may have seen the monetary policy in the past. It's very amply clear the CD ratio is not an indicator that is going to be focused on, at least in the near future. It's going to be the liquidity coverage ratio. So that is exactly what we are also focusing. We are reasonably comfortable from a liquidity coverage ratio, and that's a metric. So CD ratio is not something that we will be focusing for some time.
The current margin that you're talking about, we will urge you not to look at quarterly. We have mentioned that in the past. At the minimum, you should look at annually in terms of margin, because quarter to quarter, there are several customer needs that we will meet. If we start to focus on short term, we will not be able to meet the customer needs and appropriate franchise growth for the medium to long term. So we will not we will urge you not to bother with anything to do with quarter.
Our expectations of NIM is that in FY27 it should be range bound, assuming no rate movements. Of course, there will be some impact on account of FCNRB deposit program and loans against FCNR deposits, which could be sort of slightly NIM dilutive. But overall, as a bank, we would continue to look at leveraging, growth, and as you rightly pointed out, risk-calibrated profits through optimizing various levers where NIM is clearly one of them. Coming to your point on slippage, I think it will be better if you compare that number over Q1 26 over Q1 27. I think there are seasonality impacts. If you look at that number, in Q1 2026, it was about 62 billion, which is now down to 55 billion.
The last quarter gave us an opportunity to build on the corporate book because the capital market started offering better spreads, and that is why you would see on the credit substitutes we grew 38% quarter on quarter, and it was purely opportunistic. Same was the case on the loan portfolio. Last quarter we had slowed down because the yields were not right enough for us to continue to lend money, and this quarter we saw an opportunity. So we have a small portfolio of short-term loans which we modulate and calibrate in line with the kind of pricing we get. Credit substitute side, we look at the yield curve and our cost of fund, and if opportunities are right, we build it. For instance, if you look at the large amount of money which is likely to come in through FCNRB, we will see an opportunity that the investment book will grow from here.
We have not changed our structural NIM guidance of 380, including the time period that we have mentioned in the past. Like Amitabh mentioned, we think this is the bottom of the cycle in this quarter, which in some ways, from our perspective, would mean that from here on, the effort will be to continue to move towards the structural NIM guidance that we have during the time period that we had suggested earlier. Amitabh also mentioned that there is an FCNRB opportunity coming up during this quarter, which would mean that there might be surplus liquidity, which we'll try and deploy in terms of making sure that there is the right way to deploy and get growth on the back of that liquidity as well.
Welcome back. You're watching Closing Trades, and we're joined by Abhay Agarwal of Piper Serica. He's founder fund manager at Piper Serica, joining us this afternoon. Abhay, great having you as always. Abhay, one of the trends we spoke about last time, and always good catching up with you, was the EMS space and the entire import substitution opportunity. That certainly has played out beautifully, right, over the last month or so since we last spoke. Still value, you believe? I'm sure it's a multi-decadal opportunity, but timing it is also fairly important, right? You can't be buying it at egregious valuations and holding on to it just because you're holding on to it for a decade.
Yeah, good afternoon. Thanks for having me.
Good afternoon.
You're absolutely right. I think it's a tough balance for investors to say, look, great long-term opportunity, but how much of the current valuation is already borrowing from the future? Because that's where your returns that you generate even over next 5 years, 8 years, 10 years get decided. I would say that this is still an emerging sector. Some of the companies are still small cap, some are mid cap, maybe a few are in the large cap zone. So there is plenty of opportunities left for investors. Our approach has been that we do not want to pay more than 2 times price earnings to growth for these companies. So if they get overvalued, we would wait and watch. What happens is that since these are small cap companies, at times when liquidity dries up in the markets, you get an opportunity to add them because there could be a sharp correction. At the same time, we don't want to be fully opportunistic. So it's a balance that we need to maintain, that look, we continue to own them in our portfolio, but we use every dip as an opportunity as long as the core business is strong. As you said, Harsh, that there is this is a decadal opportunity. I mean, so much of electronics that we import is going to convert into indigenous production. There is IP, there are big moats, competitive edges here that these companies have built. So these are not models that can be replicated easily because there is core intellectual property that is driving this manufacturing. I would still stay on the buy side, but I would not completely ignore the valuation. As a rule of thumb, 2 times price earnings to growth, I think, is a good benchmark to have for investors.
Times peg. Understood. Abhay, the other thing that's played out beautifully is some of the mid-cap banks. Now, you were focused more on the small cap end. Small cap hasn't done much over the last month or so. Would you believe good opportunity continue to accumulate because growth is coming back, and very likely asset quality will hold this time around. In fact, will improve this time around, and therefore this could be an opportunity which could well unwind once the numbers start to trickle through, you reckon?
No, absolutely. I think the opportunities for investors are when there is low participation. And I think low participation comes when a sector has disappointed for many years. And I think with small banks, mid-sized banks, NBFCs, we are in that zone that while people are cautiously optimistic, they are not ready to participate because we have seen multi-years of underperformance. But I think the worst as far as balance sheets, asset quality is concerned is behind us for two reasons. One, the competitive lending that was going on has stopped. It's not that banks were running to build book and price themselves of the book growth. That metric has completely gone away. I think the NNPAs and GNPAs are at 5-year low, what I can say, and improving from here. There is no predatory lending that I can see. I think liquidity is ample in the ecosystem. So what will define now the winners over laggards, I think, is just pure competitiveness that these banks and NBFCs bring to the table. If you see the large banks, the credit deposit ratio is still challenged. They are almost 95, 96%. That means they're not able to generate deposits to match the credit demand. I think that is where the small banks and mid-sized banks have a great opportunity to be more competitive, which they already are. So they're offering much higher rates on deposits, much higher rates on FCNRB deposits, mopping up deposits at a much faster rate than private banks, able to deploy them in a positive credit demand environment. So I think investors are going to be spoiled for choice in the small and mid-cap bank space and even in NBFCs. And I think this whole sector will outperform the Nifty over next 12 months.
And Abhay, I need to take a pause on this conversation because Ultratech's numbers are flashing at the bottom of the screen. 5,016 crore is where the EBITDA number has come in at. 4,850 was where it was expected in, and you can see the spike in the stock price because of the beat that Ultratech is delivering both on top line as well as EBITDA. I believe even PAT is actually a beat essentially to the expectation. So it's a strong set of numbers, and you can see the spike 2.25 higher on Ultratech. Abhay, I know you don't talk stock specific, but cement as a pack, is it something that that you're bullish on?
Well, again, this has been a segment that hasn't done well, low participation, and I think there are worries. There were worries about the whole monsoon impact to construction, but I think most of it is overdone. I think cement is a very critical part, just like other ferrous metals for core infrastructure development. So I would stay cautiously optimistic. We are not really uh, investors in this segment per se. We are more of growth investors. But it is good to see that these companies are outperforming on analyst expectation, because that sets a more optimistic tone to the entire market, and also gives long-term investors a belief that infrastructure is being developed and these companies are able to generate profits, which kind of justifies their capex plans going ahead.
And Abhay, the last we spoke, you were also bullish with regard to auto ancillaries as a pack. Again, you've seen very decent run up, and there are some companies like the likes of GNA Axles, where they have an exposure more to the CV side of things, where the numbers have been outstanding, right? As they've started to trickle through. I mean, it's very few numbers to go by, but what is the tilt like within the auto anch pack? What would you prefer at this point of time?
No, I would stay away from OEMs, not because I don't think OEMs will not do well. They'll definitely do well, but as investors, we have finite capital, so we always try to find better opportunities. I think the whole auto ancillary and auto component, these are the two segments that we track, are in a purple patch right now. Not only domestic demand but global demand. They're able to meet a lot of companies that have invested in R&D, product development over the last 3-4 years, built great manufacturing capabilities, acquired plants overseas, are seeing very strong demand environment, and a demand environment which is very profitable. So we are very bullish on the whole component and ancillary space. But I think investors would need to make sure that they are looking at companies which have gone through a gross block increase over the last 3 or 4 years, because these are the companies that have a very strong operating leverage as their numbers go up. So I would say that this, rather than the OEMs, I would stay on the side of companies that are building complex electronics, display systems, complex forgings for the international auto market, whether it's CV, PV, two-wheeler, the emerging space of EV mobility. I think this is a great space to be in, Harsh.
Abhay, I'm sorry, but I'm going to have to pause this conversation, switch out, bring in Gaurang Shah of Geojit Financial to try and break down the numbers of Ultratech. I'll come straight back to you, Abhay, in just a couple of minutes. Gaurang, thank you for coming in and at fairly short notice. How are you reading in the numbers? The top line is better than expected, but it's essentially the margin number, or rather the EBITDA, the absolute EBITDA number, which is around a couple of 100 crores higher than what the expectations were. And that is flowing through on PAT. Around 100 crore of that is flowing through on PAT. Talk to us about how you're looking at the numbers.
So, Harsh, thank you so much. Good afternoon. All standard disclosures by SEBI in place. We have a positive coverage on Ultratech. And I think looking at the numbers, and I hope, again, I'm assuming there is no one-off or any extraordinary item, I will put it in one sentence: big boy has delivered. And my sense, Harsh, is that the consumption of cement over a longer period of time is looking quite robust, with the kind of infrastructure creation at center, at state level, and more importantly, Harsh, the change in the real estate sector that we are witnessing. So, and of course, I believe I read a statement, if I'm read it right, I think operating efficiencies have been put in place, and that is one of the reasons why the operating profit has given the kind of number that it has given. So EBITDA per ton is also improved, and I think overall numbers look quite strong.
Sustain, Gaurang, is that something of a hint that you're getting based on the reading that of the numbers? Of course, we'll have to wait and watch for management commentary, but can it sustain this tricky Q2 of sorts?
I think the negative part or the negative environment in terms of overhang is in the rearview mirror. I am assuming this, Harsh. You don't know, with geopolitics and the kind of impact that it has on world economy, including our markets. And one thing that I look forward is that whatever destruction has happened in the Middle East, Harsh, given the kind of cost effectiveness that Indian cement manufacturing companies have, I'm just opportunity like cement even for ferrous and non-ferrous metals, as long as recreating the infrastructure which has been destroyed in the Middle East.
Gaurang, just very quick question. Would you play through Ultratech? Would you play through some other cement players? How are you suggesting your clients play the cement space?
Well, I'll put it in this way, Harsh. If you have deep pockets, Ultratech. If your pockets are not very deep, you have other investment ideas. You have ACC, you have Ambuja, you have Dalmia Bharat, you have Ramco Cement, you have JK Cement. There are a lot of preferences. Yeah, but Ultratech happens of the sector.
All right. Gaurang, thank you so much for coming in, giving us that perspective. 1,100 rupees a ton is what the EBITDA per ton number has come in at, which is in line with the FY26 full year numbers for Ultratech. Of course, we'll give you a bigger breakdown of how the numbers shape up as they come through at us. But Abhay Agarwal still with us, and thank you, Abhay, for waiting by so patiently. Unfortunately, perils of news. At IT, I know you're not particularly bullish on IT, but you have to say that it's an opportunity to pick winners, right? Whether you're picking it or not, I'm not so sure. If so, how? Is there a view there?
No, we track the sector, but still early to say if there are any winners. I think the whole sector right now is moving towards becoming system integrators of various technologies, from software development, application development. The business models seem to move towards taking various pieces of technology. Some of it is AI, some of it is non-AI, some of it is enterprise SaaS, and stitching complex solutions for large enterprise clients. Now, that is a business which has challenges because it is not as remunerative. Your margins are going to be lower compared to 20% plus. It will be 12 to 15%. And in that case, the valuations, P multiples, which were all 25 times plus, will all adjust downwards to 15 times. So I think there is, unless companies come out and start talking about changing their business models, it's very difficult to see where is growth going to come from, because it's not going to come from pricing for sure. Pricing will be under pressure. It is not going to come from volume because none of these companies are now hiring anymore. So where will, as an investor, I'll make return coming in at this price? So unless I get an answer to that question, Harsh, I think we're going to stay away for the time being.
Yeah, I mean, super interesting because, rarely have we seen large cap IT trade at sub 15 times earnings. I mean, it's a totally new world, right, Abhay? The last piece, Abhay, is private sector banks, and you've stayed away from the larger ones. And by private sector banks, I meant the larger ones. You've stayed away from them, and correctly so. Would you tactically buy them on dips? Because now these also aren't trading at particularly expensive valuations. It may not require too many triggers for a bit of a run-up on some of these counters. Give us a sense as to how you're looking at this space.
Yeah, Harsh, I think this space is something that, again, we look at it. But since we are growth investors, unless we see clear growth and unless we see price earnings to growth ratio that is favorable, we would not look at it right now. And I think my problem with the large banks is continuously their lack of competitiveness. And that lack of competitiveness has led to this situation where their credit deposit ratio is 96% or thereabouts, which means they're just not able to get the deposits, create liabilities to build assets. So unless they fix that, unless they become competitive, unless they are competitive in terms of generating the FCNRB deposits, where some of the international banks are offering leverage of 19:1 to generate these deposits. I don't see where will the growth come from. Again, it's easy to predict growth for banks because your liability book increases and then your asset book increases and then you get into that virtuous cycle. Unfortunately, the three or four large private sector banks are not in that virtuous cycle. Asset quality is not an issue, but it's just that where is growth going to come from? And then you look at a situation where the price to book multiples continue to be the highest in the world. So I think this is a space that will probably reward investors, but I don't think the time to buy them is now.
Okay. Abhay, thank you so much for joining us and giving us that perspective. Of course, conversation interrupted, but nonetheless, the takeaways taken home. Thank you.
Thank you.
All right. And what we'll do, viewers, is slip into a very short break, come back. Plenty to talk about. Plenty of stocks making news, including the likes of an Ultratech, which is flashing at the bottom of your screen. We'll get you a breakdown of the numbers of Ultratech on the other side and give you a better perspective. We'll also take a chart check from Kunal on that one. Stay with us.
71 points lower, so definitely off from the day's lows, but still look at Axis Bank. It's down about 5.5%. HDFC Bank clocking in a 5% loss. Maruti down nearly 3%, Kotak down 2%, and then M&M, Interglobe Aviation, Eternal, TCS pretty quiet in trade, as is Reliance, which ran up ahead of its numbers, and now since then it's softened out a little bit. But a lot of charged up and renewed vigor across some of the other names. Look at a trend, for instance, that's holding up a good 3% in trade. Cipla is holding up 2%. Ultratech has reacted very positively to its numbers, up good 2% in trade. PNB, Union Bank, JSW Energy, Torrent Pharma, Oil India, these are all dots of green. The good thing is not as much about the index, but look at the breadth of the market. That, as opposed to where we came into trade when it was favoring the declines, that's nicely opened up in favor of the advances. Now it's a count of 144 within the F&O universe, and that's a good 2:1 ratio that we're clocking at a time when you've got so many large caps and high weightage counters from within banks, which are still under pressure. So good signs once again coming in from the broader end of the market. Let's also welcome on board Richard Jain now and ask him about what he's making of the market. Richard, hi, afternoon. First a call on the Nifty Bank, Axis, HDFC, Kotak on one end, and then ICICI Bank on the other.
Yeah, hi, very good afternoon. Well, I think if you look on the index front, then we are still into that consolidation phase for the Bank Nifty, where 57,000 is a good support, whereas the index is not able to surpass that 58,500, 58,700 mark. So the near-term trend remains sideways for the index. But yes, one needs to be stock specific when it goes with the banking names, because you can see that stocks like ICICI Bank, which had shown a good relative strength in the recent past, that such a relative strength continues. Whereas post numbers, the correction that we have seen in stock heavyweights like HDFC Bank and Axis Bank would keep the upside limited for the Bank Nifty. So we think that it's better to take a stock specific approach within the banking names. And for the index, let that 58,500, 58,600, which is the resistance, let that get surpassed. Then we can expect a good directional move on the positive side.
Okay. Ruchit, in terms of sectoral preference, not just banks, but even outside of that, what's the view?
So I think, yes, the sectors which are showing a good strength, we have seen PSU banks within the banking space today are showing good signs of recovery. Stocks like Union Bank, which has shown a good relative outperformance in the recent fall as well. So I think selective PSU banking space can do well. Apart from that, if you look at the broader markets, then NBFC is one space, where apart from private sector banks, where the momentum seems to be on the positive side. Stocks like Bajaj Finance, where we have seen a good strength that could continue. And capital markets is one theme where we believe that there could be a comeback after the recent consolidation phase which has gone through. So selective sectors like capital markets, NBFCs, PSU banks, these can do good in the near term.
Okay, that's the take coming in right now on what the index composites and the sectoral leads are like. But Ultratech just came out with its numbers. Let me quickly take it across to Ashesha and get in the print. And Ashesha, seems like a good set from Ultratech.
From cement major Ultratech Cement, and across the board it's a beat. Whether we talk about spreads or whether we talk about the revenue, volumes too have come in higher than what we were working with. Revenues have risen on a sequential basis. Revenues have declined by 4%, but we were expecting about 14% decline. So as compared to expectations, numbers clearly have been a beat. Margins meanwhile have come in at 20.3% versus expectations of 20.2%. So even on that front, it's better than what the street was working with. But let's talk about volumes then, and we were expecting volumes in the range of 40 to 41 MTPA, and it has come in at 41.3 million tons. So again, over here on the volume front, it's a slight beat versus expectations. Now remember, EBITDA per ton, of course, was expected to decline because raw material prices have risen because of West Asia crisis. We have power costs, fuel costs, logistics costs, all of them have gone up on a sequential basis, which is why spreads look weaker when we compare them on a year-on-year and on a sequential basis. But for the first quarter FY27, spreads had come in at 1214 versus expectations of about 1180. So as compared to expectations, spreads have been higher than what we were working with. As I mentioned, raw material prices have risen 4% sequentially. Fuel cost has gone up by about 5%, and power costs too have risen, and that weighed heavy on the spreads of the company this time around. Other than that, of course, the company has also given some commentary on the wires and cables business, and they said that they're on set to launch their wires and cables business in the third quarter of FY27 itself. They've reiterated their timeline of launching the wires and cables business. Trial production of wires is currently underway, and out of the total planned investment of 1,800 crores, about 888 crores have already been invested in the company. Now, as far as capacity expansion and capacity expenditure is concerned, the company says that they will be increasing their capacity by about 16 MTPA by the end of this year, and the total capacity is likely to come in at 242 MTPA by the end of next year. So capex plans continue to remain intact. 240 MTPA has in any case been their guidance for FY28, so that also continues to remain on the positive side. So all in all, numbers have been better than what the street was working with, and even when we compare the volume figure and the EBITDA per ton figure, it has been better than street expectations.
Okay, thank you so much for that, Ashesha. That's the print with regard to Ultratech. How is it looking on charts, Kunal?
Looking a little better from the previous price trends because the stock was largely into a range around 11,500, 700 was the resistance for Ultratech Cement for the past 2 months. But on the downside, the stock had good supports at 10,700 mark. So this looks like a 1,000-ish point kind of a range for Ultratech Cement. However, the major resistance for the stock is still at 12,400 mark. So maybe I think with this mild bit of a breakout, that slight better tinge in terms of the volumes, might expect the stock to head towards 12,400, which I think would be a big breakout test for Ultratech Cement.
Okay, that's the take coming in on Ultratech Cement. In the meantime, the government has granted a 6-month extension to the ALMM2 mandate for select solar projects, allowing rooftop and open access developers to try and continue using imported solar cells until December. While the move delays a near-term demand boost for domestic cell makers, it is also expected to benefit renewable developers such as JSW Energy by lowering the project costs. What does it really mean for the listed entities? Let me take it across to Meryl and try and understand that.
That's right. The government has given rooftop and open access solar developers a 6-month breathing period. Let's take a look at what this means. Well, under ALMM2, developers were supposed to start using domestically manufactured solar cells instead of the cheaper imported ones. And the idea of this was to create guaranteed demand for Indian solar cell manufacturers. Vari Energies, Premier Energies and MV were all among the key beneficiaries from this. But now the ministry has announced a limited exemption until the 31st of December, which is allowing these developers to continue using cheaper imported cells. This is only for the next 6 months, and mainly because many of the players had already locked in supply agreements from imported players abroad. So what is the market impact from this? Well, for domestic solar cell manufacturers, it's a near-term negative sentiment, as they were expecting a sharp jump in orders starting for the first quarter, which is going to be delayed for another 6 months. But the developers can continue sourcing cheaper imports, which is also reducing the pricing power for domestic manufacturer players in India. However, the long-term story from this is still intact, as the government has maintained that this is only a short-term move, and starting the 31st of December, any solar projects from this will have to comply with the ALMM2 mandate, meaning that domestic solar cells will become mandatory after the stipulated time period. Among the key beneficiaries today is JSW Energies. The stock is up almost 4%, and the extension is allowing it to continue to source these cheaper imported cells for its near-term renewable pipeline. As of the fourth quarter of FY26, nearly 67% of its 32.1 gigawatt locked-in capacity is renewable, making this development a meaningful one for the company.
Well, JSW Energy, clearly the one which is flaring up in trade. Not quite the case then with the likes of Avari Energies for sure. That's the one stock which is under pressure as we speak right now. And then Premier Energies as well, which is slight bit under pressure as we speak, mildly soft now, or rather picking up in trade as we speak. It's now recouped its major losses for the day. But Kunal, if on the charts of JSW Energy in particular, and this is a big move, what else do you foresee here?
Yeah, this could be a big resurrective move for JSW Energy because the stock largely from its 2025 start point has hardly done anything. 2024 highs, of course, for the stock was around 750, 800. The start of 2025, the stock had fallen down to 430, 440 mark. And then for the period, since then, the stock has been just gradually consolidating or trading to a range. The breakout point for JSW Energy would be the breakout of the previous highs around 600, 620 mark, which was tested, I think, in the month of April or May 2026 for the stock price. So largely, I would believe that this move could probably be termed as a point where the stock may try to retest the previous highs of 600 plus levels over the near term. But once that level gets taken out is where I would believe that a second round of a major up move could begin. So for traders who have a shorter term time frame, I think at current levels, they could look out for a near term target of 600 plus at least.
Interesting. And Ruchit, what's the take with regard to maybe an Eternal, a Swiggy, some of those names? Also, if I can throw in a Paytm, because numbers expected at some point of time, I believe today. What's the view on some of these platform companies?
Selective names can do better. Basically, Paytm has got the strongest chart structure. If you look at recently, that rally from 1,000 to 1350, 1400 witnessed good price volume action. Then you've seen some 4 to 5 days of consolidation, but there's no volume-based selling happening in this consolidation. So the 20-day support has now shifted to 1260, 1250. Until this is intact, we believe that Paytm has a good upside potential towards 1500 to 1550 in the short term. Swiggy, we have seen some pullback move off late, but again, the follow-up move is still missing. And even if you compare Eternal and Swiggy, then Swiggy definitely has been a relative performer compared to the other one. So until we see a follow-up buying emerging with good volumes, I think one can avoid bottom fishing there.
Okay, let's take a very quick break on that note. Ruchit, thanks for joining in on the show. Good to speak with you as always. Good going for the broader end of the market. We'll address some of these movers from the various sectors like power, pharma, textile and cement, but on the other side of this break.
Welcome back, and we're joined at this hour by Pashupati Advani of Global Foray. Of course, Kunal continues to be with us. Pashupati, great having you.
Hi, Harsh.
What is it that you're seeing on ground, Pashupati? What are you finding interesting?
Well, unfortunately, I think we're just floating in a range because every 2 days we get news of the states getting open, the states getting closed. And obviously the states getting closed is not good for us at all. So, I mean, it was declared over the weekend that they're shutting them again. So therefore, our markets have reacted. Obviously, the reactions are not as, vociferous as they could be, but they are showing signs of pain because, we do need, oil and gas and all the other things from the Middle East. And we're also sending exports to the Middle East to go out to the rest of the world. So as long as that channel is shut, we are experiencing difficulties, and India Inc. is having some issues in all this. So that's my basic thought about what's going on.
Right. So Pashupati, hi, afternoon. How do you stay afloat? What sectors are looking safer right now as opposed to the ones sensitive to news flow from West Asia?
Well, the ones that have succeeded so far have been the pharmaceutical sector, because we continue to take more tablets, and also the export market is still there for pharmaceuticals, so they continue to do well. And of course, anything to do with India, whether it's infrastructure, whether it's cement, whether it's steel, there is a lot of activity going on, particularly from the government side, to finish roads. For the real estate people, they're finishing their buildings under RERA. So, these commodities are required, and you are actually building something new. So that is all very good, and that's all very productive. But in the meantime, you have, the banks that are floating, not doing that much. The Reliance itself has been all over the place. It's up 2 days, down 1 day. So, that's also another challenge, even though the big IPOs are coming. But, I really feel one thing, which is that we're waiting for this FCNR-B deposits to come to India, which will definitely come. Some part of it will come into the public markets. And because of this way the scheme has been positioned, people are not excited about it. You need a little more excitement, which means the government is going to have to either request the banks to pay a slightly higher rate, which they will cover, or, the bond markets will have to allow money to be borrowed at a slightly lower rate, because it's very, very difficult to get 3, 4, 5-year money with India risk at less than 5.5%, and that's kind of been the stumbling block, according to me.
And Pashupati, some numbers have come our way. Anything standing out to you in terms of numbers or commentary?
In terms of results for companies?
That is correct.
You're talking about?
Yes, based on the updates we have.
Yeah, so obviously, this is the first beginning of the cycle. So the good companies come quickly out and give you results, and the faster companies get rewarded. The real challenge is what happens to the second half. The first half have come within expectation, maybe slightly higher than expectation, which is good. But I think the second half is where the difficulties will come, and we'll see which of those companies are hurting a little bit. Like, for example, last week, the OMCs were down because of refining margins and oil going up. And, it's really going to be very interesting to see what their results are going to look like. And I think, that we'll take it forward going from there.
Okay, I'll just pause the conversation, switch focus. Tensions in West Asia remained elevated as the US carried out a 9th straight night of strikes on Iranian military targets, while Tehran reiterated that its sovereign right over the Strait of Hormuz are non-negotiable. In fact, Sumita here with more.
That's right. Amidst tension soaring in West Asia, what we've heard from the Iranian side, particularly from Iran's foreign ministry spokesperson Ismail Baqai, is that the sovereign rights of the Strait of Hormuz are non-negotiable. Remember, this commentary is coming in even as tensions between the United States and Iran have escalated, and of course in recent days over who controls the Strait of Hormuz. In fact, Baqai also stated that an MOU is worthwhile if all parties are committed to it. But the silver lining amidst all of this is that Baqai has indicated that intermediaries have shared messages with Tehran over the recent past few days. In fact, the U.S. Secretary of State Marco Rubio has also reportedly stated that the U.S. is receiving signals of Iran's desire to negotiate. And remember, this is coming in even as the U.S. CENTCOM claimed that it completed the 9th consecutive night of strikes against Iran. And these strikes targeted command centers, air defense sites, missile facilities, and communications networks. This also says that the goal of these strikes remains to degrade Iran's capabilities that are threatening shipping in the Strait of Hormuz. In fact, amidst all of these skirmishes and, of course, the escalation of hostilities, what we've seen reportedly is that the under-construction Dhaka Wind nuclear power plant site has been attacked as well. However, Iran has reported no radiation attack. In fact, there have been multiple attacks in the vicinity of the Bushehr plant as well. And meanwhile, from the Iranian side, as expected, Gulf states like Bahrain, Kuwait, Jordan, they have been attacked. And in fact, these states or these countries have intercepted drones. In fact, when we talk about the Strait of Hormuz, well, that is the key contention between both the sides on who really controls the management of the Strait of Hormuz, because this is something that has been expressed from both the sides. In fact, if we see what Marco Rubio stated, he said that it is clear that some people in Iran want to control the strait and hold that as a leverage against the world. And this is something that Iran has very categorically mentioned ever since the MOU was arrived at in June. Meanwhile, what's also happening is that South Asia's top diplomats are going to express alarm over renewed hostilities. In fact, this is going to be at the East Asia Summit of Foreign Ministers meeting. And the attendees include U.S. Secretary of State Marco Rubio, Chinese Foreign Minister Wang Yi, Russian Foreign Minister Sergei Lavrov, amongst many others.
Okay, thank you so much for that, Sumita. Pashupati, coming straight back to you with regard to the lenders in particular, those four large banks that have come out with numbers, the NIM compression, probably a bit of a concern, but talk to us about how you're looking at the numbers overall. Do you believe that the value buys at this point, can it go lower? Just based on the numbers that we've clocked?
See, the NIM compression is obviously of concern, but if all of a sudden you get another 100, 200 billion in FCNRB, that's more money to lend, and then the earnings will then go back up. So I think we're waiting, and again, the markets in India tend to be based on flows of money. So once money starts coming in from abroad, and it's going to suddenly come. It's just suddenly people are going to say yes, let's do it. A lot of my people that I talk to are looking at maybe doing some leverage, so they're waiting for term sheets. So far, the banks have not been that aggressive, but suddenly, if they decide they're going to do it, then the money will come very quickly. So I think that is that's going to be good for India, because at least the money will be in the system. And then, that's what we need. We need long-term money that's lying there. This is 3-year, 4-year, 5-year money that can't go away. So that's good. That's all very good for our country, and that'll bring stability. In the meantime, we're floating up and down. I will just give one word of caution. Donald Trump seems to be extending the war with Congress for 60 days at a time. He's just done it. He's got one more shot to do it, because after that in November, it'll be a new Congress, and I don't know if he's going to still have the majority. Plus some senators and congressmen in the last month, some 4 or 5 of them have actually passed away. So, that's another challenge. The numbers are changing. So he's not going to be able to control and do a war if he loses control of either Senate or Congress. And it looks likely that one, if not both, will be lost in November this year.
Interesting. In fact, since we're talking about the lenders, banks clearly have been in focus because of the earnings. Let's hear out what the management commentary has been, specifically from Federal as well as PNB.
On NIMS, in terms of guidance, we had mentioned in our earnings call that we are looking at 5 to 6 bips around those levels per quarter. But obviously, it won't be linear, not repeated every quarter. There will be some quarters where it may be a bit less, more, but yeah, we still stick to the guidance which we had given at the beginning of the year. It's like 86.6, and we have mentioned earlier that we are comfortable operating, in this band. We will obviously try and not go above 90, and 86.6 is the current quarter CD ratio.
I think entire this RAM portfolio, because the RAM is whatever we bring the portfolio, it is a very, very consistency is there. And we all know that the yield also comes under this retail agri and MSME sector. So one is that consistency will be there in the growth, and as well as the profitability also will be maintained in this particular activity. So that is the reason bank is putting a lot of focus on the RAM activity. And still a lot of opportunities are there, because we are still having around 56 to 57% the RAM share in the overall credit portfolio, which we want to cross it to 60, 61% going forward. So still enough room is there for us to grow in the RAM sector.
Okay. And Pashupati, would you prefer the smaller banks over the larger ones? Therefore, growth will be faster there, likely. So some bit of that pessimism may actually go away with regards to the larger, some of the smaller banks. Also, how do you look at PSU banks versus private?
So I actually think that this FCNRB, the bulk of the money will come into the known big names, and also the ones which are like quote unquote quasi multinational banks like RBL, which now has now owned by Emirates NBD, and DBS, which is a subsidiary of the Singapore Bank. So I think those are the kinds of banks which are going to get, plus of course the big ones like ICICI, HDFC, because they are the ones who have offices outside. I mean, they are the ones who have a presence outside, and they're in a position to get that money and arrange the leverage. So I think that they're going to benefit. For the second tier and smaller private banks, I think it's going to be difficult. It's not going to have that much money walking in the door. And the other thing that when you mentioned on PSU banks, it's even lower in the totem pole, according to me. State Bank apart. I mean, State Bank is going to obviously there because they have offices everywhere, but and maybe PNB. But I mean, once you get to the next level, and Bank of Baroda also, maybe get to the next level, it'll be difficult for them to raise money in that space. And I think that's very, very important. They all need to get money from that space once the window opens properly.
Pashupati, what's the view on IT though now? I mean, valuation attractive, but of course, you know, it's very case by case basis right now. Still awaiting what we're going to hear from Infosys.
So I actually am not wild about that sector at all, because I honestly think that the business model has changed. I am not seeing any proof, either guidance or in terms of products and things like that, of any of our big IT companies who have been able to pivot properly. They're all trying to pivot. There's like, let's say, a quarter pivot, but you know, they've got hundreds of thousands of people working for them. And I think that, you know, unless there's a complete pivot and business comes to us, it's not going to happen. And this pivot has been very, very quick because of AI coming into the system. And, you know, yes, those who are able to get engineers who are able to program AI will survive, but that's only going to be like 10% of the workforce. It's not going to be the hundreds of thousands of people that are working. So I am actually not very happy with that sector.
Pashupati, what is it, how are you looking at some of the other pockets? You know, there's this huge transition from where auto and companies are now doing, you know, or foraying into the aerospace kind of segment, right? How are you looking at some of those themes? Could they be decadal themes? Are valuations justified? Is this an opportunity to go and pick up some of those names?
So I think what a lot of companies are trying to do, they're trying to split that business. So they're trying to put in a separate legal entity and then float it and split it out, because then it gets benefits from this Atmanirbhar. It also gets benefits from being able to get into the defense sector, and the multiples of defense are much higher than the multiples of the auto companies. So in terms of delivering value to shareholders, I can see a lot of companies actually splitting into two and putting their defense business separately and taking it forward like that. So there's going to be a lot of interesting opportunities that are going to come out of this. And plus, you know, some of them are involved in electric, so then they're going to split off those businesses also, that, you know, we're in the fully electric business, so our parts are going into electric vehicles. So I think those are opportunities that are going to come up. And anyway, the main auto companies seem to be, you know, on fire, because stuff is getting sold and people are buying more and more cars and vehicles and two-wheelers and everything. So those numbers all seem to be good.
Okay. You know, the other one which is buzzing in trade, Kunal, is a Mrs. Bector's. It's not the first day. It's the third or the fourth straight day where the stock is on a tear, 13% higher in trade today. On charts, still a buy. Is this still an opportunity?
Yeah, it's a very good move for Bector Foods, you know, because the stock has not just moved back from a 5-quarter underperformance, but I think from those 175 levels moving towards 210, 212 mark, it's now on the verge of breaking back above its 200 moving average. If this happens for, you know, Bector Foods, this could be a very strong breakout after almost like 12, 13 months of the stock trading sub the long-term moving averages. The last time when the stock had broken past, you know, below those averages was when the stock was at 300, 350 range. So which means that we could be looking at such a kind of a strong multi-month, multi-quarter up move for, you know, Bector Foods. Also, I think on the quarterly charts, the fact that the stock is down for the past, you know, 5-6 consecutive quarters also brings in a case that there could be a good amount of, you know, mean reversion which could be at play. And ideally in such scenarios, we look at the previous 2-quarter highs to be retested. That level is around 250 mark for Bector Foods. So in multiple scenarios, we look at a potential possibility of the stock in the next 3 to 6 months hitting zones of 250 plus at least over the near term.
Okay, that's that on Vector Foods. In the meantime, let's also take stock of what's happening within the metals universe, and just going to bring up some of those metal counters for you in trade right now. While you are seeing definitely a good move on a JSW Steel, let's check in on the likes of a Hindalco, Nalco. Hindalco also holding up 0.6% in trade, and Tata Steel will just come up for you on your screens next. In fact, we chatted with Jayant Acharya, the joint MD and CEO at JSW Steel, who are maintaining their FY27 volume guidance. He also says that the Blast Furnace 3 expansion has now been completed and the benefits are going to be seen in the Q2 or Q3.
So the Blast Furnace 3 in the first quarter was not operating much. It just started towards the end of June. And it would ramp up in quarter 2 and subsequently fully be operational in the next few months thereafter. So quarter 3 and 4, you will see a much better impact of the BF3. The furnace has been upgraded by an incremental 1.5 million tons for the full year capacity. So I think we would be able to capture a major part of that as we go into the full year.
Pashupati, just wanted to pick up on the point on staples as you see it right now, because just going by the quarterly updates from a Dabur, Marico, etc., it doesn't seem that the weakness in monsoon or the food inflation impact has quite hit the rural economy so far, and the demand seems quite, intact there so far at least.
Yeah, for sure. And I think people are moving towards branded product, and I think that's also making a difference. It's a slow transition from the unorganized to the organized sector, and it's beginning to happen in tier 2 and tier 3 cities as well. So, what you're suggesting, the FMCG sector will obviously benefit, and maybe Mrs. Bector's Foods, which you mentioned a little earlier, would be one of the ones that is likely to move faster because it's just probably being opened in those markets. And I think that's, maybe that's a vision that's also coming, as of course, the Daburs and the Maricos of this world, which continue to do better.
And Pashupati, how do you look at the entire metals pack? I'm just trying to understand, 8-9% correction in frontline names, good opportunity to buy?
Yeah, I think, as I mentioned, the metal sector is where you're actually producing value. And I think that, that's definitely a sector that should be looked at. I actually, any company that's doing specialty metals, very difficult to find. But I mean, otherwise, you've got aluminum is obvious. And, the specialty steels also will be, ones which will be worth looking at and worth picking up. I think that that's one of the sectors that's going to continue to do well. There's been a little bit of hubbub because of the breakup of Vedanta into its various pieces, and people are not understanding, what is there. But that will also settle, and then that will also, people will start buying whichever, whether it's Hindustan Zinc or copper or whatever. So they'll decide which of the Vedanta babies they want to buy. And I think that then people will decide, and then these things will stable. But all in all, I'm very comfortable holding metals.
And also, I mean, would you in this equity market, would you go and buy equities? Would you go and buy gold, silver? Would you go and buy bonds at maybe 7%, 10-year India? How should asset allocation really play out? And how should one really do their allocation at this juncture? Give us a sense of that.
So the one thing, this is my hypothesis, that all the countries that have used their oil when the West Asia crisis started are filling up or have filled up again. And to do that, they've sold gold. That's why gold has come down to $4,000 type, and which is a solid support level. I think that once they finish buying and they filled up their tanks again and they get the deliveries, then people will move back into gold. So I think that's one movement that is bound to happen. The other thing that's going to happen, according to me, is that you mentioned about equities versus 7%. 7% is attractive, but Indians stock market players have got greedy in their old age, and they want 14 and 15%, which they're now realizing doesn't happen easily. So I mean, I'm advocating that you should have some money in 7%, and then you take your bets on sectors that are going to deliver value for India, and ideally sectors that are not import dependent. So, power is one, telecom is another. These are the sectors that will do well. So,
Right, makes sense. Kunal, what is your reading on the charts? And does it seem like, once again, we are set for a meaningful bounce in gold prices?
It looks like, Aisha, because this $1,500 correction for gold prices on the dollar terms from 5,500-ish start of this year towards 4,000 mark, a major retracement cycle is completed for the gold prices. And that, I think, could be a major factor, because generally we've seen that when gold prices come back into a retracement, especially when the indicators were significantly overbought 6-7 months back, that cool-off generally ends closer to a major retracement zone, which has happened this time around also for the gold prices. So now I think the base over here, what we're looking out for is, which is a major support for the prices in the near term, are at the sub 4,000 mark on the dollar terms where we've hit the lows. Also, I think on the indicator fronts, we were looking at the last 3 to 4 months of chart patterns. The indicators for the gold prices have also come back into an oversold territory. So that also calls in for a decent bounce over the next maybe 1 to 2 months.
And gold over silver, Kunal?
So I think silver, which was at an exuberant stage in Jan end 2026, there was the gold-silver ratio, which had hit an extreme where silver had actually significantly outperformed gold prices. We've seen the ratio now to come back towards the mean. So which means that when we look at the historical context of what happens when the ratio comes back towards its mean or closer to its mean, it's where gold prices, they generally tend to perform or at least show signs of slight outperformance with respect to silver prices. So if I have to anticipate the movement, say for the next 3 to 6 months, if the prices move up higher for gold prices, silver would tend to underperform or be at max at par performance with respect to gold.
And Pashupati, do you have a view, gold versus silver?
I mean, I think they're both equally good. Gold is easier because more people, quote unquote, follow it. But silver has an industrial use, which means at the end of it all, you need to replace certain things. It's particularly strong in the semiconductor industry and other such industries which are required for India's growth. So, but at the moment, I kind of agree with Kunal. It really doesn't matter which you buy. One may temporarily outperform the other, but they both head in the same direction.
That really seems to be the case. The big movers today, of course, have been some of the earnings reactions. Look at a PNB, for instance. That's spurt up very nicely. There's, of course, JSW Energy, like we were flagging off. Trent has done very well. Ultratech Cement came out with a solid set of numbers, and that as well has bounced up quite nicely. But there's also Bajaj Auto, which is expected to come out with a strong first quarter number, driven by robust export demand and healthy earnings growth as well. In fact, let me take it across to Avi and understand what exactly is the ET Now poll pricing in.
Bajaj Auto is going to come out with its Q1 FY27 earnings, and let's have a look at what we are expecting here at ET Now. We expect the revenues to come in at around 16,960 crore rupees, which will be up by around 35% on a yearly basis, and the EBITDA to come in at around 3,400 crore rupees, which will be almost flattish on a sequential basis, up by just a mere 2%. Talking about the adjusted PAT will be around 2,760 crore rupees, which will be up by 2% on a quarterly basis. Talking about the EBITDA, margins are likely to see an impact because of the commodity cost pressure that the automobile industry is facing, and the margins are expected to contract by 70 bips, coming in at around 20.1%. The export market has performed very well for Bajaj Auto, with the two-wheeler and three-wheeler exports outpacing the domestic demand, while the demand in the domestic market has seen a modest growth for the quarter gone by. The increase in revenue is led by the increase in exports, better volumes, better realization, the price hikes that the company have taken, and a favorable forex position that the company holds because of exposure to the export markets. The margins, as I told you, are likely to contract basis the commodity cost pressure, and the earnings are reported to be healthy on a top line basis. What will be important to see is the margin impact in this quarter. A few of the things that we would look out for is the demand outlook that the company would give for both the domestic market and their export market, the kind of margin impact that the commodity cost has, and what the margin number would be, as we expect the margins to contract by around 70 bips, and the kind of price hikes that the company would take to offset this margin impact. So this is our preview for Bajaj Auto for the Q1 FY27.
Okay, that's that on Bajaj Auto. Kunal, stack up some of these two-wheeler charts for us from autos, and what's it looking like? And is still Bajaj and TVS the strongest of the lot?
So I think TVS and Bajaj are the ones which are emerging to be a better breakout candidates. Recently, we've seen almost like a 7% to 6% jump up in the prices for Bajaj Auto, and the stock which had actually underperformed for the past 3 to 6 months prior. The stock had struggled to break past about the 10,800, 11,000 mark, corrected from those levels, and now it's trying to come back towards a reselective move. Eicher Motors is the other one, which is of course one of the strongest ones so far on the charts. Even in the short-term time frame, the stock is now, I think, just 100, 120 points away, which is broadly 2% from the current market price in terms of a potential breakout. TVS Motors in this leg has been a little bit more slow mover. The stock has somehow taken or gone into a bit of a range at 3,500, 3,650 thereabouts. So it's been stuck into this 3, 4, 5% move for TVS Motors. But I think I would sense that Eicher Motors as well as Bajaj Auto are the ones which are strong. Hero MotoCorp, the stock keeps on showing those signs of emerging as potential turnaround. But then when we look at this cumulatively over the last 3 to 4 months, the stock has been consistently making a pattern of lower highs and lower lows. So we need to see one level of a breakout higher for Hero MotoCorp. Maybe that could happen once the stock breaks 5,100, 5,150 mark.
Okay. The other one will be a Bajaj Auto, of course, which will come out with numbers. I just very quickly, Pashupati, do you have a view with regard to some of these two-wheeler makers, rural demand, if at all that were to continue? Because we have seen decent demand on the rural side of things. Is the two-wheeler place a good kind of sector to play?
Yeah, obviously, I think it's a leading indicator of what's going on in rural, and it's the first, first port of call, if you want to call it. And I think you're seeing the numbers because of their ability to be able to sell in rural. I wish it would be turned the other way, which is that better roads produce better vehicles, but this way it's more vehicles is hopefully going to turn into better roads. Let's hope that prophecy comes true.
Okay, that's the take coming in on some of the two-wheeler majors. We're going into close, of course, with weakness across the banking names. Yes Bank, AU Small, HDFC Bank, Axis have been some of the key heavyweight drags. Add to that a Kotak as well, which also fell about almost 2% odd. Reliance has gone in extremely soft after its numbers, while it started off okay and then from there just has been range bound. Although the move on Friday ahead of the numbers, which was much stronger, it had a move of about almost 2.25% coming in. Today it's been much of a fizzler really in trade. Tata Motors PV, Wipro, Asian Paints, Tata Consumer, flat for Bajaj Auto, flat for Eicher Industries, Eicher Motors rather. Eternal as well has been a little bit soft. And then BEL, which is also closing in just mildly soft for the day. Pashupati, defense seems to have gotten into a little bit of a sideways and consolidation mode. You think this is a good buying opportunity?
I don't think so, because I don't think that, fund managers are looking at it saying, Indian defense is the best thing since sliced bread. We did see a lot of buying when a whole bunch of defense-specific funds got set up, and that got money from the public and that got invested. So I think it's kind of losing its luster. It doesn't look like we're going into the West Asia war, that's for sure. So, I think the pressure has come off to try and produce, defense stocks. So, I think they've sort of been forgotten at the moment.
Kunal, how is defense looking on charts? Would you also avoid that entire pack?
Yeah, nothing exciting on the charts. Most of these stocks are still into their sluggish downtrend or lack of that volume phase for themselves. These stocks have struggled to show any kind of a major breakout in the recent past, at least in the last 2 to 3 weeks. So that's why I would probably just about keep it on the sidelines, maybe wait and watch for these different stocks.
3% on PSU banks, really, that's the space which is actually lit up in trade and has gotten better as the day has gone by, in fact. Realty, Pashupati, very quickly, is that something that you believe will be a trend over the next 12 months or so in terms of something we can pick?
No, I feel realty, the trigger is not yet shown, because I think that prices are soft. They're going to have to carry. There's a lot of put it this way, there are a lot of opportunities, but each builder has got limitations, and it's going to be very interesting because, we've got half a dozen really big builders, and then we've got another lots of intermediate builders and then small builders which are not listed. I just feel that the industry is also floating because there's a lot of stock around. And some of the numbers that I'm hearing are quite scary, and as to how much property is lying vacant and how much is going to be produced. So I would just sit and wait. There is going to be a trigger. At that point, it'll be time to get in, but I don't think that now is the time.
Okay, Pashupati, always great having you on the show. Thank you so much for your time today and joining in. Just a minute left to go before we ring the closing bell for the day. And today, of course, the biggest casualties have been Axis and HDFC Bank, which have single-handedly, along with Kotak, of course, contributed maximum to the market fall today. Having said that, the Nifty has managed to resurrect itself in terms of where it started off in trade. From there, of course, we've recovered quite a bit of lost ground. Power, pharma, textile, oil and gas, metals and FMCG have been the leading sectors today, while private banks clearly has been the biggest drag. PNB held out well. The breadth of the market opened quite nicely. JSW Energy did quite okay. Union Bank held out nearly about 5% in trade. Oil India was up over 4%. And then Manappuram as well, which held out 4% in today's trading session.
Okay, let's quickly also pick up on some names which came out with numbers through the weekend. Axis Bank was the top casualty from that list. 5.5% lower. HDFC Bank down 5+% now at close. India Cements is the other one, 4.5% lower. Yes Bank down 3, IDBI Bank down 2.5, Kotak Mahindra Bank down 2. The only bank possibly sitting in the green is an ICICI Bank and a PNB, of course. Those margins getting better, clearly working in favor of PNB. So some very strong moves seen on that stock. There's RBL also, which is closed in the green. Outside of that, Bansali Engineering came out with numbers, good numbers. Turtle Mint, first set of numbers declared 6.5% higher, and Tatva Chintan was the star of the day, 20% higher on the back of those numbers. We had a couple of initiating coverage notes. In fact, all of them buzzing in trade. Craftsman is up 3.5%, MQ Pharma up 4.5%, Sansera Engineering up 4%. All those three stocks on a tear as it's played out. Mrs. Bector's gains another 11% in trade today alone, outside of all of the moves it's made in the last few days of trade. IT was okay. We closed in around flattish on the IT index, but outside of that, PSU banks were the leaders in trade. 2.7% higher on Nifty PSU Bank, 1.4% on Pharma. Those were the two sectors which have done very well. 1% lower on the Nifty Bank, 0.25% lower on Nifty Auto and IT. That's how we've closed for the day. But Kunal, what do you expect from the rest of the week?
See, I would be bullish on the markets, and I think after this day of price consolidation for the indices broadly, the markets should gather pace at least by the end of this week. My expectation is that we could be hitting back towards at least 24,500 mark by the end of this week, because the next week expiry is actually showing a lot of built up at the 25,000 call strike. So hopefully, I think by the end of this week, or at least by the mid of this week, we may try to test the 24,500 mark. So bullish on the index for the very short term period.
Okay, Kunal, thanks as always for joining in. We'll catch you again tomorrow morning. In fact, on that note, we'll wind it up right here on this edition of Closing Trades. Thanks for watching.